Michael, bank shares have collapsed this year. They're down by as much as 25%. Is this justified?
No, I mean, definitely not. I mean, you're quite right to point out that bank shares have had the worst start to a year in living memory. I think the fall, though, has been completely overdone. And when one looks at the robustness of the banks compared to the time of the crisis, then it's like chalk and cheese. And certainly the falls that have been seen in recent weeks are totally unjustified.
So what has been driving this market rout?
Well, I think there are a couple of things going on. One is clearly interest rates now are looking as though they're going to stay lower for longer. And low interest rates are bad news for banks. They put pressure on bank margins, they put pressure on bank profitability, and that in turn means lower dividends, lower payouts to shareholders. But it's not the only factor that's at play. There's been considerable uncertainty about the impact of regulation, and specifically concerning whether banks are going to have to stop paying their coupons on some of these special instruments taken to prevent banks suffering bailouts in future, these so-called COCO instruments. There has been considerable uncertainty as to whether banks are able to pay out their coupons on this, and this has obviously exacerbated the downturn in bank shares.
And would you point to any specific regulation that is putting pressure on the kind of economics of the banking industry?
Well, I think that from a regulatory perspective, it's more a question of lack of transparency about how regulation works in one or two instances. I mean, specifically, we obviously had a couple of European bank shares that came under considerable pressure as the market felt that the margin that they had to continue to pay the coupons on these so-called COCO loans was very, very narrow, and that regulators might force those companies, those banks, to stop paying those coupons. So what it really is uncertainty which has driven hold of those instruments to basically sell those instruments and also sell the underlying equity as part of a hedge against the prospect that they will have to forego their coupons on these COCO bonds.
But to your earlier point, fundamentally, the individual institutions in the industry as a whole is in a much stronger, a much better place than it was 10 years ago.
Yeah, absolutely. I mean, both the BCBS and the EBA have very recently published their findings on banks' capital and liquidity positions. And what we see for European banks is that they have an average core equity tier 1 ratio now of around 12%. I mean, that's massively higher than it was at the time of the crisis. And in terms of liquidity requirements, they're already 20% above the required level of liquidity 3 or 4 years earlier than they need to be. So the banks are in significantly stronger position than at the time of the crisis, points which have been made obviously by the heads of the SSM and other regulators, but are worth repeating.
So does that mean that banks are seriously oversold?
Well, my personal view, and it is just a personal view, is that the banks are oversold. They do face still some significant headwinds, particularly in trying to deal with an ultra-low interest rate environment, which, to be honest with you, has probably been exacerbated by the extension of quantitative easing. This will continue to put pressure on banks' margins and will hinder their ability to grow their top lines. But in terms of overall solvency and strength, the sector is in a very robust position. I think, therefore, that they're going to be able to use their capital increasingly to fund more generous dividend payments across the sector. There will be exceptions, but by and large, I think the stability that we're beginning to see in the regulatory environment will allow the banks to be more generous with the shareholders, and that in turn, in my personal view, should be reflected in higher share prices in due course.
Thank you very much, Michael.